Hi, so we're going to be presenting about pensions and termination benefits. I'm Mike, Yeshka.
Max.
I'm Vibhu.
Rohan.
And I'm Hassan.
Right, so the IFRS standard we're going to be talking about is IAS 19. Then we're going to move on to summarizing how the various companies note disclose their policies, how they present pension benefits and termination benefits in their financial statements, and just their general accounting policies. Then we're going to talk about the similarities and differences in the related. Then we're going to talk about the ASPE standards and the differences between them and IFRS. And finally, we're going to restate one of the company's financial statements and notes using ASPE.
So under IFRS, employment benefits are covered under the standard IAS 19, and Canadian GAAP requires that all entities classify their post-employment benefit plans as either defined contribution, DCP, or defined benefit plan, DBP. So a defined contribution plan is when an employer makes a set cash contribution into the fund every period that's invested on behalf of the employer by a trust. And a defined benefit plan is simply classified as anything that doesn't fall into the above category. So jumping into DCPs, it's the more simpler plan obviously, and it's simply where the entity's obligation for each period is simply determined by the amount that has to be contributed by that period. And the way that's recognized is simply when service is rendered by the employee, the company will record some type of contribution payable to the plan itself, along with an accrued expense. And if the contribution happens to exceed the amount that was actually of the service that was rendered by the employee, an asset is recorded, a pension asset. And as far as disclosures required, the entity simply needs to disclose the amount that was actually recognized as an expense for the DCP. And moving on to DBPs, these can either be unfunded or wholly funded or partly funded on behalf of both the employer and the employee. And the way it's simply recognized is first, the value of the plan assets itself is determined, and this is the actual amount that's being invested by the trustee. And as well, using some type of an actuarial technique, the actual value of the defined benefit obligation is also determined. And the difference between those is used to calculate whether there exists a net defined benefit liability or if there's a net defined benefit asset, which is when the value of the plan assets actually exceeds the defined benefit obligation. And what's included in the P&L statement are any changes that come from the service cost, interest on the outstanding net defined benefit liability or asset, and lastly, remeasurements, actuarial remeasurements, gains and losses, which ends up going into OCI. And as far as disclosure is concerned, IFRS simply requires that all characteristics of the plan and risks be disclosed, all amounts from the financial statements arising from the DBP be disclosed, and lastly, simply to describe how the plan may affect the certainty and timing of future cash flows. And lastly, moving on to termination benefits, also in IAS 19, it's simply any benefits provided in exchange for the termination of employees. And that's the result of either the entity's decision to terminate the contract, or if the employee happens to accept some type of termination package. And the way this is recognized is obviously as a liability and an expense, and that's done at the earlier of when the entity can no longer withdraw the offer of those benefits, or when the entity recognizes costs for restructuring that involves payment of these actual termination benefits. And as far as measurement is concerned, it's fairly simple, measured upon initial recognition, and any subsequent changes are adjusted. And for disclosure, because it's so simple, there's no specific disclosure for any termination benefits required. And as well, because of the nature of these items, we won't be going into this too much detail for our presentation. And now we'll pass it on to Rohan, who will go over the first company.
The first company we decided to look at was SNC Lavalin. For their pensions, they have both defined benefit and defined contribution plans. The amount they pay their employees is based on how long they earn and their pensionable earnings. So the longer they work with the company, the more they get paid. On the financial statements, remeasurements done by the actuary go to OCI, and the service and interest costs hit the income statement. And these actuarial revaluations, which hit OCI, have to be done every 3 years. And the last point I want to touch on is note disclosure. There's a general overview of where it's disclosed in Note 2, and more specific note disclosure with the reconciliation schedules in Note 31.
Right, so CBC. So CBC has more than one defined benefit plan. So I don't actually know the exact amount they have. The main one is the CBC/Radio Canada pension plan, and this is funded and contributory, and the other ones are unfunded and non-contributory. Now, for all of these plans, the amount of pension obligation for an employee is based on the average of the 5 best consecutive years of pay in the last 10 years of employment. And another accounting policy is that CBC doesn't actually close the OCI remeasurements into AOCI. They close it directly to retained earnings. And because the only OCI expense that CBC ever has is related to pension remeasurements, they don't actually even have an AOCI account. In their financial statements, pension liabilities are included in long-term employee-related liabilities, and as I mentioned, there's no AOCI account. And they give their note disclosures related to pension liabilities in Note 2, Note 17, and Note 3 because of a change in IAS 19.
Thanks, Mike. For Cineplex, like many of the companies that we will be looking at today, they have both the defined contribution and defined benefit plans. For the defined contribution plan, they're mostly reserved for their Cineplex employees. However, they do have defined benefit plans for both their executives as well as some of the former employees of Famous Players, a company that they acquired back in 2005. So right now they're still grandfathering a lot of those plans. More importantly, they do not have they don't have a set time period for periodic evaluations, whereas SNC would do evaluations every 3 years. Cineplex does not have anything of that sort. In terms of financial statements, they're presented on a net basis, and at the moment they're significantly underfunded at $6.5 million. However, as expected, and as their workforce ages, there will be more contributions to the plan assets. And for note disclosure, 2, 3, they're very standard. 2 for significant accounting policies. 3 for the adoption, for the first time adoption of IAS 19, amended in 2013, and 19 includes pension note.
The last company that we looked at was Maple Leaf Foods, and like the other companies that we mentioned earlier, it too has the defined benefit and defined contribution plans. And how they get the values for this is just the best estimate of the salary escalation and the mortality rate. One interesting fact about financial statements is that for Maple Leaf Foods is that they don't actually net the plan assets and obligations. They actually keep them as separate line items on their financial position. Also, remeasurements go to OCI like any other IFRS compliant company. And the big note disclosure for Maple Leaf Foods on pension plans is in Note 10, but Note 13 and 19 also mention it.
Right. So just comparing all of our 4 companies together now in one slide. Starting with SNC, in their income statement, they had expensed approximately $5.3 million. And as you can see, the expense was unspecified, meaning that it was disclosed in their notes, but it wasn't actually specified which line item it's actually included in. In their statement of cash flows, they actually paid out, so cash outflow of roughly $82.1 million, and in their balance sheet, the liability was included and grouped as part of their provisions. For CBC, their pension expense was split among the 3 categories of employees, so media employees, corporate management, and transmission employees, and between all 3 of them, the expense amounted to roughly $134.5 million. And on their statement of cash flows, their operating section, to account for the non-cash items, they simply added back the difference between the actual income expense, pension expense, in the income statement, and the actual cash outflow that was paid out. And lastly, in their balance sheet, again, as before, the liability was simply grouped together along with the other long-term related employee benefits.
As for Cineplex, very similar situation to SNC and Maple Leaf, in which on the face of the income statement there was no line item. However, we do know that they record $855,000 in pension expense during the year. For the statement of cash flows, there was no distinct information once again, but if there were, the line item would fall under cash flow from operations. And on the statement of financial positions, pension expense was recorded under post-employment benefit obligations under the long-term liability section of the statement. For Maple Leaf Foods, again unspecified, however, they did record a $59 million expense somewhere, and they did disclose it in the notes section. In terms of statement of cash flows, the increase in pension liability and the increase in long-term debt both increase the cash available in their respective sections. The statement on the statement of financial position, there's something very unique about Maple Leaf is that, unlike all the other 3 companies, Maple Leaf did not net the net value of their pensions, which meant that they recorded individually the plan assets and the plan liability, or the obligations. And again, disclosure notes came in 10, 13, and 19. So for ASPE, it's recorded under section 3462. And again, just to briefly go over it, for defined contribution plans, there are no differences between them and IFRS. However, the difference arises in the defined benefit plans, where there is no OCI. That's something that we know from ASPE. This is very important because when it comes to actual gains and losses and any sort of adjustments later on and remeasurements, they do not have a specific statement to go to, which means that it goes into retained earnings. And this increases the volatility of the financial statement of financials, or of the balance sheet over time. Best estimates must be used in terms of actual evaluations, and this must be consistent from time to time, from year to year. Total pension expense under ASPE is the sum of current service costs, finance costs, and remeasurement costs. And remeasurements, whether they're gains or losses, are expensed in the period that they incur, rather than going through or hidden through another method or hitting OCI, which does not exist once again. The same goes with any changes in asset ceiling as well. So in terms of disclosure, no disclosure for ASPE, there are many major ones and there are a couple of smaller ones. So major ones would include disclosing what sort of valuation techniques you've used or the company has used when determining their pension plan assets. They must identify if there's any uncertain numbers. Obviously, we want to be as certain as possible with numbers that we're presenting to our users. And they must individually disclose any discontinued operations and disposals. Furthermore, on the balance sheet, if they're defined benefit plans and assets, they must be separately disclosed in a different line. And small things like plan surpluses, deficits, valuation allowances, and any changes in the nature of the pension plans that are different from the previous years must be disclosed as well. So now I'll pass it to Hassan and Rohan, and they'll go over SNC output.
So the company we chose to restate from IFRS to ASPE is SNC Lab. Highlighted here, since it was disclosed in Note 2 that their pension benefits were included in Note 2 in provisions, we highlighted provisions here on the balance sheet. There's a current portion and a long-term portion highlighted here.
Next, we see that financial expenses are highlighted on the statement of profit and loss. And this is because in IFRS, this is where SNC puts their pension expenses embedded into this expense item, and they don't actually have a separate one. So that amounts to $163,548.
In IFRS, actuarial remeasurements based on experience and based on a change in assumptions go to OCI. This is an excerpt from the note disclosure that shows the reconciliation schedule for the impact on OCI. Based on these changes in assumptions and experience, the defined benefit pension plans and other post-employment benefits changed, and this amount, 2,241, shows up in OCI, which in ASPE would show up on the income statement.
So as Rohan was mentioning, this OCI statement that's included in the IFRS version of SNC's financial statements would not be included in IFRS, except that highlighted number of 2241, which is the actuarial loss, in ASPE would actually be expense, which is what we did when we restated the statement. So if you go to the next slide, you can see that the highlighted portion is the actuarial gains and loss. The 2241 comes up again, and we've expensed it in ASPE because there is no OCI, obviously. And
also, when you expense something, your net income before taxes goes down, but you have to take account for the tax effect of this decrease in income. So the company uses the comprehensive tax allocation method, but for the purpose of this calculation, we just simply use the liability method. So the expenses went up, causing your net income to go down, causing your taxes to go down, still causing your total net income to go down, but not by the full amount. And this is finally, we have the cash flow statement here, so as a result of less income taxes paid, it is reconciled back in the operating section of the cash flow statement, and it has the impact shown by the red numbers on the far right side.
that concludes our presentation. Thank you for watching.